Hello, this is Jordan and this is your Precious Metals video market update. Today is Tuesday, February 10th, 2015. And in recent videos we've been focusing quite a bit on the metals themselves and also currencies. Today we're going to take a look at the gold stocks. First off, we have a chart here of GDX, the large cap gold miners ETF. And this is a daily line chart. We also include the 400-day moving average, which, in my opinion, is one of the most important moving averages. You can also use the 80-week moving average on weekly charts, or on monthly charts you can use the 20-month moving average. Look at a number of markets over the last 15 to 20 years, and this moving average, in my opinion, is a much better indicator of the primary trend than the 200-day moving average, which most people use. And we can see here how clear it is with GDX. It was holding the market in 2011, and then in early 2012, GDX fell below the moving average, failed to retake it, looks like in March. Then go to summer 2012, that's where the summer rally stopped. And since that point, GDX has tested the moving average on 2 occasions. Now, I believe we're starting to see a change of character in this market. Now, the reason is twofold. First of all, look at the double bottom that we had in recent months. The real strongest double bottoms are when you have one that occurs, the 2 bottoms occur over a 2 or 3 month period. Because it's a short amount of time, but it's not too short where you're only looking at like a week or a day or a month. A couple months really gives you the kind of support that is going to last for quite a while. And so that bottom that we have there, it's a strong base compared to what we had at the 2 previous bottoms in December 2013 and then in June 2013. I mean, there isn't much of a base at those bottoms. Now, so that's a bullish factor, the fact that we have that double bottom in place. And before we get to the second point, you consider that in the context of this is a bear market that's almost 4 years old. It's the second longest bear market in gold stocks dating back to 1942. And in terms of the price decline, it's very close to being one of the worst. So when you consider that fact, we're more likely to go into a bull market soon than not. Now, secondly, look at the tests of the moving average. When the market was falling apart in 2013 and parts of 2014, the market went almost 2 years between testing that resistance. So after the market tested the resistance there in August, September of 2014, it collapsed, but the market in recent months quickly rallied back up to the 400-day moving average. So the time between those tests was only about 4 months or so. So that's a good sign that the market is gaining more strength and that it's, perhaps getting ready to break above this moving average. Now, the context of that is not something in the very short term. The context of that could be something maybe in the next 3 to 6 months, but I'm just guessing. So, in other words, we're seeing more positive developments here, but it looks like the short-term trend is probably down because the market failed to break above the moving average. But lastly, keep an eye on the moving average. Looking at this chart, it's quite clear that if the market, GDX that is, gets above the moving average, it's going to signal a new bull market for the gold stocks. Now, here's a monthly chart of the Huey Gold Bugs Index. Monthly charts are the most significant. They're obviously more significant than weekly and daily charts. Really gives you a great picture of the long-term trend. And we can see here that the Huey bottomed around 150 towards the end of 2013. And in fact, the Huey spent 3 months testing that bottom. So, the longer you test a bottom like that, especially when you're looking at a weekly or a monthly chart, the more significant that test is. And so the market tested it for 3 months, and then it had a very strong rise in January. up to that resistance at 205 to 210. Second point, 150 has been key support dating back to, it marked the 2008 low, and it also marked resistance in 2002. So very significant point. There's also very significant support at around 165. So given that the short-term trend is down, maybe the Huey will test 165. I don't know. I'm just putting it out there. But given that 150 is major support, and given that the market tested it for 3 months, and another point, the fact that, as we noted in the last slide, bear market's almost 4 years old, it's highly unlikely that we're going to see another breakdown to new lows. It's more likely that we're going to see a new bull market develop, and obviously the market's got to take out key resistance like the 400-day moving average. I'm sorry I don't have that on this chart, but looking at this chart, that key level is going to be 205 to 210 on a monthly basis. So we need to see the Huey take that out again on a monthly basis. If there is a bullish outcome coming, I sketched out perhaps what it could look like. We're in a range right now between key resistance and major support. Like I said, the short-term trend appears to have turned down, so short-term bias is probably to the downside. But like I said, if there's going to be a bullish outcome in the coming months, perhaps it could look something like this. Now, lastly, another reason why, even though the short-term trend has turned down, I think you don't want to get all bared up again with respect to the miners, is there are some positive fundamental developments out there. Now, in this chart, we look at gold priced in the Canadian dollar because the vast majority of mining companies tend to be headquartered in Canada. So the Canadian gold price is, I don't want to say it's more important for them, but on a micro level, it's obviously very important. And if the company is exploring in Canada or operating in Canada, producing gold there or whatever, then the Canadian gold price is obviously very, very important. So the Canadian gold price, as we know, gold price against foreign currencies, we've talked about it a lot, reached a 21-month high. It looks like it's pulling back. Obviously, it got very overbought. But still, looking at that, it looks like it's clear that the bottom is in there, and that could be back in a bull market, gold in Canadian dollar terms. So that is a positive for a lot of mining companies in Canada, and especially not just the ones that are headquartered there, but more so the ones that are exploring there and producing there. Now, secondly, energy can be about 25% of the costs of mining. Energy prices have collapsed. That's very favorable for the mining companies. So these are two developments that we've seen really take hold in the last couple months that are really positive for mining companies. I should say really positive for Canadian mining companies. Again, you have to look at this on a micro level because if you're a company operating in the U.S., strong dollar is hurting you. And last, we have gold price against industrial metals. We kind of use that as a proxy for industrial costs. For example, the cost of steel or the cost of blasting agents. Those are things that get used in mining. And gold has also perked up. If we see that ratio go above 425 and gold gets back to that 2012, 2011 high, it's another small positive for gold. So these are just some fundamental developments that kind of have happened under the surface, so to speak, that it's just another reason I think you don't want to get all bared up again with respect to the miners. And that's all for today. You can follow my work at thedailygold.com. We have a free newsletter, free email newsletter, and also a premium newsletter. You can email me any comments or questions, Jordan at thedailygold.com. Thank you all so much for listening and watching. I wish you all the best in 2015 and the years beyond. Thank you.